Now the next type of ratio that we're going to talk about here, now this is called an investment-based ratio. Now, all the other categories of ratios are called financial ratios. And that's because all their inputs come from the financial statements. You'll see here with these investment-based ratios now that one thing you need is the price of the stock in the market. And the price of the stock in the market is not found on the financial statements. Technically, these are not financial ratios. Nonetheless, they want you to know a little bit about these kinds of things, and we're going to talk about that right now. Now, there's two types of investment-based ratios we're going to look at. One is called the price-earnings ratios, the PE ratio, and the other is known as the price-to-book ratio. First one we're going to talk about now, the price-to-earnings ratio. The numerator in this equation, P, is the price of the stock in the market. The denominator, E now, this is earnings per share. To calculate earnings per share, you take the earnings available to the shareholders, the common shareholders, and you divide that by the number of shares outstanding on a balance sheet in the equity section, in the common stock section of the equity section. They'll give you two numbers. One they'll tell you is the number of shares authorized. Authorized shares now, that's the greatest number of shares that management can ever sell, ever in the future. The other number they give you now is the number of shares outstanding. And that's simply the number of shares that they've sold to shareholders to date. So if you went to your balance sheet and you saw that earnings available to the shareholder was $100,000. That's that number at the bottom of the income statement. And you noted that from the balance sheet, the common stock section of the balance sheet, that the number of shares outstanding was 10,000, then this company's earnings per share would be $10. Literally what that means is that for every share that you own, you're entitled to $10 of this earnings available to the shareholder. So if you own 10 shares, whatever this $100,000, $100 of it belongs to you. Okay? That's earnings per share, and that's what it means. If you're looking at a company, and let's say that this company's stock is selling for $100 in the market, and its earnings per share is 10, then they would report this company's PE ratio as being 10 times. And what that means is that the price of the stock in the market is 10 times the size of the earnings per share. Okay? Now, is that good or bad? Well, the PE ratio is an indicator of what the market expects the growth of the company to be in the future, the growth of earnings to be in the future. The greater the PE ratio, the greater the expected growth. The lower the PE ratio, the lower the expected growth. So as an investor, all things being equal, you'd like to see your company's PE ratio go way up. Okay? And by the way, 10 times in the market right now, the average PE ratio is over 23. So this company, as we look at this company here that we made up, that would be considered a very low growth company right now. Again, the higher the PE ratio, the higher the expected growth. The lower the PE ratio, the lower the expected